Hey option traders, for today's trade we're looking at a bullish option play in construction equipment rental stock United Rentals. United Rentals was IBD's stock of the day on Tuesday, and shares have been on a tear higher recently. Looking at URI on MarketSmith, shares are building a base and are trading mildly below Friday's high of 358.56, which serves as an alternate buy point for investors. Shares are also less than 20 points below a 368.04 handle buy point from a consolidation. The stock currently ranks number 1 in its industry group, which itself ranks number 19 out of IBD's 197 groups. This is a sign of leadership for both the stock and the industry. A perfect composite rating of 99 is very bullish as well. Shares are currently above their 50-day and 200-day lines and are holding support at the 21-day moving average. So with all of this bullishness in mind, we can consider looking at a bull-put spread here. This is one of the 4 basic vertical spreads that you can use when putting on an option trade. The bull-put spread involves selling one put and buying a lower strike put. This creates a credit as the more expensive option is sold. The goal is for the stock price to stay above the higher strike price to keep the full premium. This is a mildly bullish position. The idea is that we sell a put just as we would a cash secured put, but simultaneously buy a lower strike put to protect the downside, just as we would with a protective put against long stock. A few positives to selling a bull put spread is that you get to collect a premium up front for putting on the trade. This position allows you to be slightly bullish on the stock, but with limited downside risk. Bull put spreads look like a covered call, but without the maximum downside risk. Because the seller of the bull put spread collects the premium, the position can profit if nothing happens to the stock. The bull put spread, however, does give up the upside above the higher strike put. The potential losses are capped with the stock price anywhere below the long strike put. To summarize, the biggest advantages with a bull put spread is that you get to collect the premium up front, you benefit from the time decay in the trade, and you have limited risk. Some of the biggest disadvantages are that your gains are capped above a certain price and the short put can get assigned. As for how to choose your strike prices, you'll look to sell at the money or out of the money puts. Choose a short put strike that you think the stock will not trade below before expiration. As for closing out the position, most spread sellers will buy back their position, or at least the short put before expiration. If the stock is above the short put strike, which is out of the money, the spread can be allowed to expire worthless. But most traders will close out the position at some small amount. If the stock price is below both strikes, the maximum loss will be realized. If the stock price is between the 2 strikes and held until expiration, you will be assigned the stock. This means that you will be acquiring the shares in the option. Overall, it's best to close the position before expiration. So let's take a look at my trading platform and set up a real trade using the bull put spread. So looking at URI here on Thinkorswim, first make sure you have vertical as your spread type selected here in this box. We've got our strike prices down the middle here, and make sure that you are using the June 16th, 2023 expiration up here. And we're going to select this strike price pair right here, 280 and 270. And you want to make sure you click on this side of the screen, which has the prices for put options. So to recap, we are looking to sell the June 16th 280 put and buy the June 16th 270 put. Using the June 16th, 2023 expiration, we could sell the 280 put and buy the 270 put. In total, this will generate around $225 in premium with a maximum risk of $775. If the strike expires worthless, that would be a 29% return in 6 months if URI is above 280 at expiration. The maximum loss would occur if URI closes below 270 on June 16th, which would see the premium seller lose $775 on the trade. A good rule of thumb is to limit the loss to the amount of premium received, which in this case would be $225. Sticking to this stop loss level will help avoid large losses if the trade goes south. As always, remember that if you're new to options, make sure you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.